Hello, everyone. Good morning, good evening, depending upon the time zone where you are from. Uh, Welcome to today's webinar. As you know, we focus a lot on education and learning as a part of our initiative, these webinars that we are conducting. I appreciate all of you taking time to be here today as a part of this webinar. And before we start, a couple of things to note down, like the information which is provided in this presentation is for general education and discussion purpose. And this presentation does not provide any legal, investment, or tax advice, because each individual's circumstances are different, and you should always seek legal or tax advice to address any specific questions you may have. And during this webinar, if you have any questions, you can always type in your question under Q&A box, and please do not type any question in chat box. And this webinar will be recorded and will be uploaded on our YouTube channel, Smart Accountants. So you can always go back and refer anytime in future if you want to refer them. Today we will discuss various aspects of the streamlined compliance procedure. As you may be aware, US has a set of complex rules and regulations which develops change rapidly with the new proposals, new interpretations. So practically every year something gets changed. In order to mitigate any risk with the IRS, as a taxpayer, you must be proactive in making sure that you comply with all US filing requirement. It is very easy for any taxpayer to become confused or even to fail to comply with all these tax obligations. If you are one of those who have missed out on filing any of the international filing and reporting requirement, for which penalties are very huge, we will see in a few of the slides as well. So today's webinar in that case will help you to understand some of the important aspect of the tax consequences and possible options where you can be tax compliant without incurring any penalties, or depending upon your situation, maybe minimum penalties, where you can qualify for either streamlined domestic compliance procedure or streamlined foreign compliance procedure. As a part of this webinar, we will discuss and we'll start with a US taxpayer, because if you are a US taxpayer, then your compliance requirement are different. Your worldwide income is taxable. You are subject to all the reporting requirements. So it's important to understand who is US taxpayer. As a US taxpayer, as a US citizen or US resident, or we call it a green card holder, what are the responsibilities to be tax compliant? What are the responsibilities as a taxpayer to disclose all your assets which are outside the US? There are various forms to comply with this all reporting requirement. Few of the form that you see on the screen, this list is not exhaustive. It's just inclusive. It's just a few of those forms, that form 3520, form 926, form 5471, form 8865, form 8938, FBAR, and so on. So we'll see, we'll not discuss any of this form in detail, but we'll see what are the consequences of not filing this, or if you miss out filing of this, and how the streamlined procedure can come to your rescue, where you can be tax compliant without incurring any penalties or with minimum penalties. We'll see as a part of this presentation what is the difference between streamlined foreign offshore procedure and streamlined domestic offshore procedure, how the streamlined procedure work, what things you should keep in mind, where you need to be like aware about that this streamlined procedure is not an agreement with IRS. You can be still subject to audit, who is eligible, who is not eligible, and so on, that we will discuss. Since like streamlined procedure started in 2014, we have like submitted more than 1,000 streamlined compliant filing. Um, there are few important aspects that we will see. That one is intention. If you happen to be a taxpayer where you miss out filing any of the international reporting requirement or FBAR, that miss out was not willful, was non-willful, not intended, was a honest mistake. So there are a few those important aspects as a streamlined procedure that we will discuss. So let's begin with who is US taxpayer. So US taxpayer, you must have seen if you attended any of our prior webinar, because most of our webinar are always concentrating on a cross-border transactions somewhere. So it's important to understand who is US taxpayer. So US taxpayer is a person who is US citizen or lawful permanent resident. We call them a green card holder. So if you happens to be any of these two, whether US citizen or a lawful permanent resident, it's extremely important to understand that even if you are not staying for a single day in the US, you are still considered to be US resident for tax purpose. And once you are US resident for tax purpose, your global income is taxable for US tax purpose. Depending upon the country where you are living, whether that country has a tax treaty or not, end of the day, you may not incur additional tax liability by reporting all worldwide income in US, but you are supposed to report it. In addition, you are required to report all the foreign disclosure forms and everything. So if you are US citizen or lawful permanent resident, as I said, very common mistake that sometime, particularly if you are staying outside the US, you believe you don't have any filing requirement or reporting requirement. That the mistake generally client incurs or come across. So those are the two things you should remember. And third thing, if you are not US citizen or green card holder, but you can be still US person if you fulfill substantial presence test, where you stay in US for more than 183 days during a 3-year period. And the way that calculation take place, if you are determining the residency for year 21, you will consider the number of days you stay in US for 3 years, 2019, 2020, and 2021. And you need to be in the US at least for 31 days in 21. Then all the days you stayed in the US in 21, you will consider. Only 1/3 of the days you stayed in US in year 2020, you will consider. And only 1/6 of the number of days you stayed in US in 2019, you will consider. So that is how this calculation works. And if you want to see the example, you can always go back to our prior webinar where we explain them with a couple of examples how that actually works. So the purpose of that presentation was or slide was to explain you what are the requirement, or you need to be like as a US citizen, as a US resident, what are your responsibilities. Once you are US resident for tax purpose, you have to report all your worldwide income, even if you are not earning single penny from the US, even if you are not staying in the US for a single day, you still need to report your worldwide income on Form 1040. In addition to that, various international forms that we talk about, or on the first slide we saw, depending upon where you made the investment in stock, bonds, you have foreign bank accounts, mutual funds, you have investment in the foreign corporation, foreign partnership, you receive gift from the foreign person, you receive something in inheritance from a foreign person. So there are so many instances where you will have reporting requirement. Those reporting requirement may not add additional tax burden on you, but the penalties of not reporting any of this form, missing out any of this form, is huge and unbelievable, that we will see in next few slides. In the same way, FBAR is applicable when if you happens to have foreign bank accounts or interest in the foreign bank account or signature authorities in a foreign bank account, and you have more than 10,000 of the balance. So these are the few forms. Again, in the next few slides, we will give you some overview of what's the cost of non-compliance. So we'll not be discussing any of this form in detail, because all these forms are such that if we start talking on them, each of them will require a separate session. So today we'll just go through them and we'll talk about like what the Form 3520 is, Form 926 is, Form 5471 is about, when you are required to report Form 8865, 8621, 8938, and FBAR. So Form 3520, what happens if you happens to be beneficiary, trustee, or where you receive income from the foreign trust, then, or you receive some gift from the foreign person, you receive some inheritance from the foreign person. All are the examples, circumstances when you have reporting requirement of Form 3520 and maybe like Form 3520A, that's a foreign trust annual reporting requirement. So all these circumstances presents a liability as a taxpayer on you, where you have to comply with the reporting that you receive this amount of gift, you receive this amount of the inheritance, you receive this amount of distribution from foreign trust. So all are example where you have to attach Form 3520 with your tax return. And if you miss out any of these, the penalties are huge, which is 5% of the gift amount per month, and maximum it can go up to 25% of the gift. So you see the consequences. If you report, it's just an information form. You don't incur any additional tax liabilities. As you know, like if you receive something in inheritance, that is not a taxable event, right? If you receive something in a gift, that's not gives you a taxable event. There is nothing like a taxable thing. But if you miss out reporting them on your return, the penalties are huge. In the same way, there is Form 926, where this is often miss out things. Many a times, like a Form 5471, where you have interest, you have ownership in the foreign corporation, and depending upon your ownership percentage, you will have various categories applicable, and you need to comply with this various schedules and everything. But I have seen many a times people comply with the Form 5471 but miss out Form 926. because many a times in the software, you don't see this form as well. So when you may, as a taxpayer, when you transfer a property, when you make investment, and as a part of making that investment in the foreign corporation, you transfer cash or property, you have reporting requirement on form 926. Like how you like made that investment, what property you transfer, when you transfer, whether you transfer cash or something else. All these are just information. But if you miss out filing this form, the penalty is 10% of the value of the property transferred, and this penalty can go as high as $100,000 per return. So you see the impact. It's a huge, that if you miss out, it's going to cost you a lot. In the form 5471, as I just talked about, if you happens to have like a ownership in the foreign corporation, or if you are an officer or a director or a shareholder, then depending upon again your ownership, you can have a different filing requirement. Various schedules can be there. You can have a so-called guilty in global intangible tax reporting requirement. If you are in a high tax jurisdiction, again, there will not be any tax impact. That will not add anything to your tax burden. But if you miss out filing form 5471, the penalty is $10,000, and again it can add many more and can go up to maximum of 50,000. Next form is form 8865, where if you have made investment or you acquire ownership interest in the foreign partnership. So if you are a partner in a foreign partnership where you acquired or dispose of, or even if there is no change in ownership, but you have controlling interest, so you have form 8865 filing requirement. And again, there are various categories and schedules that you need to report that we are not going to discuss today. But if you miss out filing form 8865, when you are supposed to file, when you are supposed to attach that with your return, the penalty start with $10,000, and it can go as high as, like you see, last line penalty is kept at $50,000 per return, and 10% of the value of the property transferred, which is not reported, and subject to 100,000 limit. So again, a huge penalty. Many of you might be aware about FBAR, foreign bank account reporting requirement. If you are a US person and have any bank accounts outside the US, investment account, brokerage account, mutual funds, custodial accounts, anything like that, if you have any of these outside the US and value of all this together, maximum balance during the year happens to be more than $10,000 in total, then you have FBAR filing requirement. FBAR filing again is a different compared to the tax return, because this gets filed with the treasury and tax return gets filed with the IRS. So it's a separate requirement. Again, the penalty is a huge if you miss out to file FBAR when you have reporting requirement. You, as you see, you are can be subject to civil monetary penalty of $100,000 or up to 50% of the balance in the account at the time of violation, whichever is greater. Form 8938, sort of similar to FBAR, but much wider. in the concept, the terminology that has been used here is the foreign financial assets, which is a much broader concept compared to the FBAR. Even if you have provided loan, if you have debentures of the foreign country, sort of those things, or if you have like a ownership interest in the foreign partnership or foreign corporation, all such items are not subject to FBAR reporting, but are part of this Form 8938 reporting requirement. Again, the filing requirement for 8938 is not straightforward like FBAR, where it says more than 10,000 of balance. Here the threshold of the filing and reporting is different depending upon whether you are living in the US or living outside the US, and again depending upon your filing status. So much broader definition, and threshold are again much broader compared to the FBAR. But if you miss out, and again if you see the form, there are various parts and you need to report much more information compared to FBAR. You need to report like whether you open the account during the year, not close the account during the year, whether you reported the income from the account, what and all the summary of the items that you reported on tax return, like interest, dividend, capital gains, any foreign tax credits or anything. As I said, it's a different compared to the FBAR. So if you have any other financial assets, then those also part of this reporting requirement. And as you see, if you miss out filing this, the penalty is $10,000. So what happens? What's the purpose of showing you all these forms before we jump on the discussion for streamlined filing? And the intention was to show you that again, the list that a few forms that we talk about is not exhaustive list, is very inclusive, and just a few example you can consider that all these are reporting requirement. Most of them are a kind of information return, where when you have reporting requirement and if you report them correctly, it will not add anything to you in a tax liability. But if you miss out them, the penalties is huge. So what happens? IRS is doing efforts on their part that if you happens to be any of the non-compliant US taxpayer, where the non-compliance on your part was not willful, was not intentional, you honestly miss out them. It was just a pure human error, human mistake. Then IRS wants you to come and come yourself first and report everything that you are supposed to report, and we will not charge you anything as a penalty. The financial pain, if IRS comes to you and catch you, that's going to cost you a lot more, because once IRS sends you notice, once IRS catch you, then you cannot go to this streamline and everything. Those doors will be already closed by that time. This streamlined filing compliance procedure doors are open as long as you are voluntarily coming forward. And some may things like, how IRS is going to know if I don't report it? So don't keep yourself in that mindset. We are living in a world of technology where with a click of mouse, you can control many things in the world. In addition, FATCA has been signed by various countries, which was enacted in like 2010, and as many as like more than 100 countries, 113, if I'm not wrong, have signed this FATCA agreement, where the various countries and their financial institutions can share, exchange their information with the US government. If, all the banks and financial institutions are regularly conducting that know your client sort of things, where they are collecting a lot of information about yourself. So believe me, there is nothing like a secret. It's important. If you have missed out, honestly, that's what is very, very important. And you may hear many a times in our discussion, because all these doors of streamlined filing compliance procedure are open only and only when that things of like not reporting is not a willful, is an honest mistake. Okay, so if you have failed to disclose foreign accounts, foreign forms, foreign filing, why don't you come forward before IRS finds you and you are no longer eligible for any of them? So that's the remedial eligibility. If you miss out, you have two choice. One is a streamlined domestic offshore procedure, and another one is a streamlined foreign offshore procedure, depending upon where you are living, whether in the US or outside the US. You may be eligible for one of these. If you are living in the US, you will be eligible for streamlined domestic offshore procedure. And if you are living outside the US, you will be eligible for streamlined foreign offshore procedure. There is a little difference between these two. We'll discuss about them in detail as well. But what you see is the common things between these two procedures. As I'm repeating again and again, the common theme of both the program is that taxpayers certify under the penalty of perjury that his or her conduct was not willful. The conduct was due to negligence or a mistake, and that mistake was in good faith misunderstanding of the requirement of law, accidental failure to report. Like as I said, if you are happens to be US citizen or green card holder, if you are not living in the US at all, you never like you can like have situation you are not aware about such a requirement. You are not earning anything in the US. You may think like, oh, I don't have any reporting requirement. That sort of things can be a honest misunderstanding. And as a part of this non-willful certification, IRS asks for a lot of information: your personal background, your professional background, kind of experience, what you do, not do, and explaining the reasons and everything. So this condition, fulfillment of this condition, that non-willful, that intention was not to hide anything, that is very, very important. And you have to, as a taxpayer, certify these things when you come forward and do any of this streamlined procedure. And one of the important aspect is that when you are doing this streamlined procedure, whether offshore or domestic, IRS should not have initiated any civil examination of any of the tax returns. If you are already under IRS audit, you are not eligible. That's why I'm saying these doors are open as long as you are coming forward voluntarily before IRS catch you. Okay. This procedure is available only to individuals and estates. So, but foreign filing requirement is applicable to business returns as well. If you have a partnership like or a corporation, if you have made investment outside US, most of this filing form will be still applicable to you. But as an entity, there is nothing like a streamlined procedure. you have to pay penalties if you miss out filing them. So this option is available only to individuals and estate of individuals. The reasonable cause statement, as I explained, that intention was not willful, and you have to give all the background and details and everything, and you have to explain that on the form 14654 or 14653, depending upon whether you are going for this domestic offshore procedure or a foreign offshore procedure. And if you, when you come forward, you don't pay any penalties, but whatever actual tax liabilities and any interest due to late payment, you have to pay that. But you don't pay any penalties. You don't pay late filing penalties. You don't pay late payment penalties. Okay, let's discuss about streamlined domestic offshore procedure. As we saw on a previous slide, there are two procedures. One is a streamlined domestic offshore procedure, other one is a streamlined foreign offshore procedure, depending upon where you are living. So IRS has extended this streamlined procedure to Americans living in the US with undisclosed foreign accounts who previously were ineligible from participating in the streamlined procedure. So what IRS says, if you are living in the US, IRS expect you that you must have filed your return. What could be only honest mistake that you miss out filing on this all international forms. So under streamlined domestic offshore procedure, you cannot file original return. You can file only amended return because IRS expect you to be compliant with everything. Okay, so if you are residing in the US, you must have filed all the US tax returns for past 3 years. And what you can do under streamlined procedure, you can amend those returns for anything that you miss out reporting on international front. And if you happens to be under the domestic offshore procedure, it is not without penalty, but with very, very minimum penalty of just 5% of the unreported foreign accounts, assets, and everything. So if you happens to living in the US, it's not completely like come in a channel and be a clean without anything. You will end up paying very minimum 5% penalty of the unreported assets. On the other hand, okay, before we know about that foreign streamline, let's talk like one more slide about what a domestic streamline is, and I will give a couple of examples as well. What are the requirements, like how you calculate when you can say you are qualify for whether streamlined domestic or streamlined foreign procedure. So if you are filing under streamlined domestic compliance procedure, what happens? You will be filing amended return for last 3 years for which due date has been passed, or if you have file extension, extended due date has been passed, along with all the information written that we just saw what it could be. 5472 normally will not apply into individuals because it applies to only for a foreign seller of a corporation. So you can check out that from slide. So you all other forms can be applicable. For each of the most recent 6 years. So you file 3 years of amended return and you file 6 years of the F bar for which due date has been passed, and you pay miscellaneous offshore penalty, which is 5% at the time when you submit the amended return. how that 5% penalty gets calculated? That 5% penalty is like equal to like a highest, calculate the highest balance where you miss out the reporting of the foreign assets, foreign investments, whatever the foreign non-compliant you are. So calculate the maximum value of those foreign assets during that period of the non-compliant. Then whatever maximum balance you had for each of those 6 years, you see which is the maximum one out of those 6 years. You pick that one and multiply that with a 5%. That is how that 5% penalty gets calculated. On the other hand, if you are filing under streamlined foreign offshore procedure, you don't have to pay any penalties. You just file whatever you have missed out to file. But important thing is applicable to person who satisfy this non-residency requirement. We'll see in a moment how you can satisfy this non-residency requirement. And that non-residency requirement, if you are filing joint, like both the spouse must satisfy that you are a non-resident and you fail to file FBAR or other foreign financial account, assets, investments, and again, that miss out not filing was not willful. Taxpayer living abroad who discloses their foreign accounts, settles the tax bills under streamlined foreign offshore procedure won't be charged any penalties. This is a main difference compared to the domestic offshore procedure when it comes to the foreign streamlined foreign offshore procedure. This is absolutely without any penalties, where you will be filing 3 years of tax return. Here you can file the original returns as well. So if you have missed out filing the return at all, you can file your original returns with all the unreported foreign assets and everything, and you can file 6 years of the FBAR. So a couple of differences compared to the domestic offshore procedure. In domestic offshore procedure, you can file only amended return and you need to pay 5% penalties. Here, that's the benefit. If you are staying outside the US, you can be compliant without paying any penalties. But how you decide whether you fulfill residency or non-residency requirement, there are two aspects. That taxpayer must have non-US abode. And secondly, the taxpayer must have lived outside the US for 330 full days or more in at least one of the most recent 3 years. For how many years we are filing a streamlined procedure? We are filing 3 years of tax return, right? And we are filing 6 years of the FBAR. So out of those 3 years for which you are filing, you must be living outside the US for at least one of this year for 330 full days. Let's take an example. Say you lived in the US for 365 days in year 1. You lived in the US for second year also for 365 days. In the third year, say you are filing this streamline for year, like you come to know everything in 22 and your deadline for 21 already miss out now by this time. So you are filing streamline for 21, 2020 and 2019. So take this example, you stayed in US for 365 days in 2019, you stayed in US for 365 days for 2020, and you stayed in US for 330 days sorry, last one, you stayed outside US for 330 days. So will you qualify for a non-residency requirement? The answer is yes, because what the requirement is that you should be outside the US for 330 days, at least one of the most recent 3 years. So in year 2021, you was outside US for 330 days. So you are eligible to file streamlined foreign procedure. Let's change a little bit in example. Say taxpayer who spends like 36 days in the US in each of these 3 years. So in year 2019, 2020, and 2021, and that person stays in the US for 36 days. And by staying in the US for 36 days out of total 365 days in a year, if you take out 36 days, you will not be able to fulfill 330 days requirement of non-residency requirement. So you cannot file under streamlined foreign offshore procedure. Let's take one important aspect in this. I think I have that on next slide. But before we go to that last line, as you can see, the rigid requirement of non-residency requirement can play the role of a spoiler to well-intentioned taxpayer who wants to get right with the IRS. So when someone is coming forward, it's important to see whether you qualify as for streamlined domestic or streamlined foreign procedure. I think I have the example very interesting to make this situation very interesting. Say in example 2, now you know that the taxpayer is not eligible for streamlined foreign procedure. So my question is he eligible for streamlined domestic? Answer is yes, if he has filed return for each of these 3 years and due date has been passed. Say the taxpayer who stayed in the US, who lived in US for 36 days in each of this year, filed the US return for 2 years, say 2019 and 2020. But for 21, he completely missed out to file the return. Now, can he file under streamline at all? He cannot file under streamline foreign because he is unable to fulfill that 330 days requirement, right? And he cannot file under domestic streamline as well, because the requirement for domestic streamline is that you must have filed the original return. So you need to be very careful about this residency and non-residency requirement as well. So now you know how you can be eligible for streamlined domestic or foreign, and once you are know your eligibility, you file all the returns depending upon foreign or domestic. You file amended original returns. In a foreign streamline, you can file both, okay, original as well as amended. Only in the domestic, you cannot file original. And you come forward, you file the 3 years tax return, you file the 6 years of FBAR, and be compliant with everything. And depending upon whether foreign or domestic, you can be with or without penalties. You need to file that form 14654 for a domestic offshore and 14653 for foreign offshore. It is important to understand this returns gets processed through special procedure. So when you file this return, on the top of the return, you have to put in that comment with red ink, streamlined domestic offshore or streamlined foreign offshore. And this streamlined returns must be filed in a paper form only, no electronic filing. FBAR, you always have to do electronic filing. You cannot paper file FBAR. So these are the important things. And here we are with our first polling question.
Okay, so we have a poll with us right now. Let me just read the question for all of you. How many years of delinquent FBAR needs to be filed in streamlined compliance procedure? And the first option is 3 years, and the second option is 6 years. I see a lot of people are voting for 6 years. Let's see which is the correct answer.
So how many years of FBAR you can file under streamlined compliance procedure? That's the question. So
So
I
we
think,
have around 57% people who voted for 6 years and around 45% people who voted for 3 years. That's like a very close call, I see.
okay,
Yeah.
didn't expected this to be anyway. Under streamlined compliance procedure, I think we can end this poll. If you any of them, yeah. So under streamlined procedure, uh, you can file 3 years of tax return and 6 years of FBAR. Okay, so don't get confused between 3 and 6 years. It's a completely different requirement. Tax returns 3 years, FBAR 6 years. Let's move. Okay, what you are supposed to report, disclose under streamline assets. So whatever you haven't reported in terms of FBAR or 8938 and various forms that we talk about, if you have say foreign investment, you have real estate in the foreign country, say India, is it foreign financial assets that you are required to report? The answer is no. Again, say Canadian RRSP, which is sort of like a US 401k plan. It is included on FBAR and on Form 8938, but not computed as a part of this penalty for streamline. Because there is a election available to deferral on this. So depending upon a country in which you have all these foreign financial assets, there can be, depending upon tax treaty, you can have different situations. So it's important that you describe your situation properly to tax professionals so that they can advise you properly. When you do the streamline procedure, question may arise, is it like a kind of guarantee that your return will not be subject to audit or verification? The answer is no. This return will be under regular IRS audit as if filed normally. So there is nothing like a special watch or something. But if something IRS thinks apparently asking question, asking for support, they may request account statement. End of the day, what you are not reporting, foreign assets, foreign investment, mutual funds or shares and everything, right? So whether you are reporting correct balance, if you like say filing under domestic compliance procedure where you have 5% of the balance as a penalty, then IRS if has a question can ask for. But I haven't seen many of those clients where IRS comes and ask for. Once you file, normally IRS will not give you any sort of confirmation that it is in process or something. So if there are kind of situation where in due to COVID situation, there was always a rebate recovery credit. Once they process the return, if you're eligible for those refund, you will get the refund. But other than that, there will not be any formal communication from the IRS whether your streamline filing has been processed. If nothing you receives, it means it is processed. You just have to keep with yourself the proof of submitting the return under streamline procedure. Then who is not eligible? Again and again, if you are not able to certify that your failure, that miss out of reporting all these forms and everything due to was not a willful, was just an honest mistake. If you are unable to certify this, you are not eligible. This is a common between a streamline with a domestic or a foreign. If IRS has already initiated criminal investigation, if you are already going through the civil examinations and everything, then you are not eligible for this streamlined procedure. And this brings us to our next polling question. Uh, is the late filing and late payment penalties applicable for tax return filed under streamlined filing procedure?
All right, so we have our second poll with us. And the question is late filing and late payment penalties applicable for tax returns filed under streamlined filing procedures? And we have two options, one being yes and the other being no. And again, I see a very close chase between both of the answers. One is 55% for yes and 45% for no. So let's wait and see what the end results are.
So what happens if you are coming forward yourself and saying that, okay, I honestly miss out this, then there is no late filing penalty, there is no late payment penalties, but yes, you will have to pay late payment interest. Okay, so is the answer to this question should be no. Okay, let's go to our question answer session, and I think yeah, we can go to the question answer session. And does form 1065 needs to be filed by individuals? Form 1065 needs to be filed by the partnership, not by individuals. There is a questions that ask about any threshold for the gift amount received. Yeah, there is $100,000 of the threshold. It's not every gift that you receive from the foreign national that you are required to report on form 3520. When that threshold of 100,000, then only you are required to report that to the IRS. And yes, I believe so. Portfolio amount value is over 10,000. I don't know what the question is, but for FBAR, the reporting requirement is $10,000 in total. So if you have one account where you have like a $10, other account is just a zero balance, but you are once you have reporting requirement, you need to report accounts even with a zero balance. One of the question is, are you covering SDOP tonight? If you are talking about that voluntary disclosure thing, that's a different thing, and that's not we are going to cover today. Our today's discussion was limited to streamline domestic and streamline foreign offshore procedure only. If you any of the other questions anyone has. So if you have any questions, feel free to ask them.
Anyone who has questions can send it in the Q&A sections. And if anyone has any insights or input for the webinar, you can type it in the chat box. The chat box is open for all. Also, if you want to reach smart accountants for further discussions or any queries, we are sharing our email ID and phone number on the screen, so you can reach out to us on that. We hope this webinar provided some great insights on the topic to all of you. And I'd like to thank our panelists, Mr. Amit Patel and Mr. Vivek Shah, for taking out the time and guiding our audience through this amazing and a topic that a lot of people I have seen, are super confused about. So I hope this webinar cleared a lot of doubts for you. And we have the Q&A and chat box open for the next 5 minutes. So let us know if you have any doubts or queries. Thank you.
There is some interesting question that if at the time of filing streamline, if willingly, I shall not disclose any FBAR details, and later on if IRS knows from somehow, what will be the penalties? As you saw on one of the slide, that was the reason of showing those few forms, that penalties for non-filing of FBAR is $100,000 or 50% of the balance in the account, which you miss out. So it's always advisable, come forward, disclose it yourself, where you will be able to disclose without any penalties. Again, depending upon whether foreign or domestic. In domestic, 5% penalties, rather than waiting for the IRS, because with the FATCA compliance, most of the countries, 113 countries, have filed the FATCA, including India. So it's a matter of time. IRS can come to you and catch you. So better you come forward and disclose yourself. And there is one more interesting question. What if the state income tax returns are the procedure different or follows the federal? This streamlined filing and everything is from federal point of view, not from the state point of view. So all these reporting requirement and everything are, as you see, as a part of our discussion, most of these are information form. Mostly, hardly any of them affects your tax liability. So it's all about federals and will not affect mostly your state returns. But if you are amending a federal and if your state return getting changed due to that, then it's a different ball game that you may end up. But if you are living outside the US, mostly you may not be subject to the state taxation even.
All right. So I guess that was it. It was amazing to see such an interactive audience today. We hope you stay with us through our next episodes of the webinar series. Also, for those who need the PPT or want to go through the recording once again to understand the topic in detail, we'll be sharing the same on our YouTube channel. You can look us up on YouTube at Smart Accountants, and we'll also be sharing the same recording on all of our social media platforms. So make sure you follow us and keep in touch with us. We'll be hosting more such insightful webinars in the future. Thank you. Thank you, Amit sir.
Thank you, Bini. Thank you, everyone.